Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined this week by the University of Missouri's Pat Westoff, as Ben is a little bit busy right now with some other things he's facing. But Pat, it's good to have you on.
Hey, glad for the opportunity today, Will.
So, Pat, I believe this is your second time on the program, so maybe not a full stranger to the audience and those out there. But if you don't know, Pat does excellent work with the University of Missouri's FAPRI office, and definitely check into some more Pat's stuff. So, before we get rolling too far today, I want to give a brief rundown of where we sit over the last week or so. First, looking at the nearby corn contract, we're down 9 cents at 4.45. Nearby soybeans are down 12 and a half at 12.35. That nearby wheat contract is down 1.5 at 5.96, and then U.S. crude oil on the nearby contract up to 73.10, up nearly $2 there. So, Pat, what's your, I guess, initial reaction as we've seen these adjustments on the week, mostly down for a lot of commodities, but crude oil is still on the uptick?
Yeah, I think for the most part, it's a reaction to the USDA's reports last week showing bigger crops here and overseas for both corn and soybeans than most of the market had been anticipating.
So, Ben, talking about looking at things overseas, there continues to be tension kind of spread throughout much of the world, but we had a bit of an escalation yesterday on a U.S. ship just off the Gulf of Yemen, or off the coast of Yemen in the Gulf of Aden. And so really what's interesting about this is that kind of point controls the choke point heading into the Red Sea, which is a very critical, route for trade when it comes between Asia and Europe. So, Pat, as you look at what this escalation could mean for the U.S. and just the global ag economy, I guess what does this mean? What kind of factors does this add into the mix?
Sure, there's certainly lots of uncertainty about what's going to happen anytime soon, of course, in all of this. That uncertainty, of course, can cause opposite effects on the market. On the one hand, there's worries that if there were a larger scale conflict, it could interrupt international economic growth with a negative effect on demand for farm commodities. In the short term, however, U.S. producers might get a bit of a benefit from the fact that there might be less wheat and other grain moving through that part of the world to get to Asian ports from Ukraine and elsewhere in Europe. So that could actually provide a bit of a benefit to U.S. crops.
So really looking at that short-term gain in wheat and looking at where we sit in the U.S., obviously, Ben and I, we've talked the last couple of weeks about the South American production and the markets watching the weather down there and the competition that's brought on. But this is kind of an almost an awkward spot, I guess, for the U.S. markets watching that South American crop and where things might go. So as we look maybe more long-term, how do factors like this in that region maybe impact where the U.S. sits overall?
I mean, I think we would like to hope at least that the situation in the Middle East gets resolved relatively quickly. So my own guess is, and at least hope is that this is a relatively short run phenomenon. Longer run, however, I think yes, the size of South American crop is hugely important right now, and of course we have to think about what's a likely supply of the U.S. next year. I think a lot of us were surprised by how big the U.S. crops were in 2023, and if that's a portent for what we can do even with unfavorable weather conditions, think what would happen if we actually had a favorable growing season sometime.
Well, and Pat, going off of talking about that size of the 2023 crop in the U.S., I was reading a report that you shared on Twitter last week, talking about the influx of where prices sit versus the inputs. So from where you're sitting, and correct me if I'm wrong, this has been a few days ago that I was skimming through that, but the prices of inputs are coming down, but we're really seeing a big fallback year over year on the price of corn, especially, and really across the board. So where do you see farm incomes and ag incomes maybe as we look ahead forecasting into 2024?
Sure. USDA reported record net farm income in 2022. 2023 was down because of lower commodity prices, primarily as input costs overall remained high. And in 2024, yes, we do expect to see some further reductions in a number of input prices. On the livestock side, of course, feed becomes cheaper with lower grain prices. On the crop side, we'll probably have an average lower cost for fertilizer in 2024 than we had in 2023. And you go up and down the line with other inputs, of course, as well. But the higher interest costs, the higher wage costs, et cetera, are offsetting that. And so the drop in commodity prices that has already happened and that we project will happen further in the future will result in a further reduction in 2024 farm income if things go as we currently expect.
Well, and looking at how that might pinch things, looking over the last week or so, you've been seeing a lot of cattle producers on social media going through the elements, going through the cold, especially out west, and talking about how that might lower feed costs. I don't want to bleed too far over into our cousins at the weekly livestock market update, also done by Brownfield. But looking at that feed cost short term, you'd imagine that there's still a pinch there, but what's the timeline maybe for some alleviation into these feed prices?
Yeah, again, it all depends on the growing seasons next year, obviously. But if we have, a relatively favorable year for forage, et cetera, in 2024, we could be looking at, quite a bit lower costs for at least some of the cattle producers out there relative to what they've experienced the last couple of years.
Well, Pat, also as you move forward, looking into or coming off of the USDA reports from the past week, what are you really watching and paying attention to this week in the short term, trying to figure out where the markets might go from here?
Well, again, some of those uncertain developments in the Middle East and elsewhere obviously have everybody's attention right now. We'll get more news about inflation in the days ahead here, and we'll see how that might affect the Fed's thinking about future action interest rates. And of course, we've got the situation with the federal funding for the government. And so, will we get a short-term extension passed here in the near future? And what will be the final resolution for the budget and ultimately for the Farm Bill in 2024 and perhaps beyond?
And Pat, just correct me if I'm wrong here. So when it comes to the government funding, so far, things I guess have been shortly extended through till March. Then I guess what's that date where things need to be sorted out by?
Yeah, well, they still haven't officially done that extension into March. So right now, it's still this Friday is the last day
Okay.
of funding that's guaranteed as of the time you and I are talking this morning. But the expectation is, yes, there'll be an extension. It'll take them into March sometime, and hopefully at that time we'll be able to finally get agreements for the rest of the fiscal year that goes to September 30th of this year.
All right, Pat. Well, it's a pleasure having you on this morning. Thank you for pinch hitting in a quick notice fashion. So it's always a pleasure. Stay warm wherever you are. Pat, you stay warm where you're there in central Missouri as well.
Will do. Thank you much, my friend.
All right, viewers, listeners, thank you for joining us this morning. Again, I'm Will Robinson with the weekly commodity market update on Brownfield.